It's the largest bank meltdown since the Great Recession more than a decade ago.
It is a big failure. It's the second biggest in U.S. history.
Silicon Valley Bank was the 16th largest bank in the U.S., worth more than $200 billion, catering for the financial needs of technology companies around the world, before a series of ill-fated investment decisions led to its collapse.
Really getting flashbacks of what happened in 2008.
Yeah.
The situation a bit different, but there are concerns still about what this means for the financial sector.
SVB's services were in high demand throughout the pandemic years as the preferred bank for the tech sector. The initial market shock of COVID-19 in early 2020 quickly gave way to a golden period for startups and established tech companies, as consumers spent large amounts of money on gadgets and digital services. Many tech companies used SVB to hold cash for payroll and other business expenses, resulting in an influx of deposits. The bank invested a large portion of the deposits, as banks do. The seeds of its demise were sown when it invested heavily in long-term U.S. government bonds, including those backed by mortgages. These were, for all intents and purposes, as safe as houses. However, bonds have an inverse relationship with interest rates. As rates rise, bond prices fall. As a result, when the Federal Reserve began to raise interest rates rapidly in order to combat inflation, SVB's bond portfolio began to lose significant value. If SVB can hold those bonds for a number of years until they mature, it will receive its capital back. However, as economic conditions deteriorated over the last year, particularly in the technology sector, many of the bank's customers began withdrawing funds from their deposits.
The CEO of Silicon Valley Bank, his name is Greg Becker, hosted a call with clients and said, quote, "My ask is to stay calm because that's what's important. We have been long-term supporters of you. The last thing we need you to do is panic." Well, when that's the ask as a bank, you're toast. And one person familiar with the situation asking me the hypothetical question tonight, what prevents runs on a whole bunch more banks next week? Unclear.
A bank run caused the failure of Silicon Valley Bank. The company was not insolvent or even close to insolvent, at least not until clients began fleeing. However, banking is a business that relies on trust as much as it does on cash. And if that runs out, the game is over. The collapse could have been caused by an unforced, self-inflicted error. The bank's management chose to sell $21 billion of bonds at a $1.8 billion loss, ostensibly because many of those bonds were yielding only 1.79% on average at a time when interest rates had risen dramatically, and the bank was beginning to look like an underperformer in comparison to its peers. Moody's was thinking about downgrading its rating. With the assistance of Goldman Sachs, the bank's management chose to raise new equity from the venture capital firm General Atlantic, as well as sell a convertible bond to the public. It's unclear whether the bond sale or fundraising were done under duress, at least at first. Its purpose was to reassure investors. However, it had the opposite effect. It so surprised the market that the bank's very smart client base of venture capitalists directed their portfolio clients to withdraw their deposits in large numbers. The bank and its advisors may also have made a tactical error. The General Atlantic equity investment could have been completed overnight, but the bank's management chose to sell convertible preferred stock, which couldn't be sold until the following day. That gave investors, and more importantly, clients time to scratch their heads and cast doubt on the firm, resulting in a deposit exodus. In the coming weeks and months, there will be a detailed post-mortem on the bank's failure. For the time being, it appears that the collapse could have been avoided. It occurred because management botched how it communicated with its customers and the public, creating a confidence vacuum. However, underlying the failure was a demonstrable issue that other banks should be aware of. The company had invested its deposits in low-interest rate bonds that it had held on its books for a long period of time on a hold-to-maturity basis. That means it didn't have to mark those bonds to market until they were sold, giving investors a skewed view of its balance sheet. There is no issue as long as a bank does not need to sell hold-to-maturity assets to meet withdrawal requests. However, when a bank is forced to sell at a loss, things become more complicated.
It's a fascinating situation. This Silicon Valley Bank, it seems, was not reckless in its lending. They just got one thing wrong. They took deposits like any bank, and of course, they had to pay out those deposits on demand in most cases. But they put their money into long-term bonds that are obviously something that you hold for several years.
We're also likely to hear more from Washington about bank regulation. The bank's management appears to have successfully lobbied regulators in 2015 to loosen rules that would have prevented it from taking some of the risks it did. The Lever News organization reported on testimony given by the company's president to the Senate at the time in an attempt to weaken some rules. So far, Silicon Valley Bank appears to be an outlier, owing to its unusual circumstances and client base. It had very few typical retail customers. However, there is already concern about some other small and regional banks. In the short term, the most pressing issue this raises is for Silicon Valley itself. Venture capital firms that use the bank may have difficulty accessing their funds, as well as the funds of their limited partners, including pension funds that had forwarded money intended for investment. As a result, it may be difficult to fund current and new investments, or to rescue other companies within and outside their portfolios. DealBook has already received information about secondary sales of private shares to fund both businesses and individuals. Silicon Valley Bank may be finished, but the fallout from its collapse is only just beginning to be felt. Will this lead to a banking crisis?
It is the largest bank failure since the banking crisis back in 2008. Customers tonight, of course, demanding answers and their money. The question is, could other banks be next?
Immediate fears of widespread contagion were alleviated by the U.S. government's prompt response in guaranteeing all deposits of bank customers. In response to the guarantees, financial futures, which allow investors to speculate on future price movements, rose for the U.S. technology sector. There were fears that if that guarantee was not implemented, SVB account holders would be unable to pay employees, causing ripple effects throughout the economy. They have avoided supply chain consequences in terms of stability. Governments and regulators worldwide, including the United Kingdom and Australia, are looking for SVB exposure in their corporate and banking sectors. Longer term, the question is whether SVB's vulnerability to rising interest rates is shared by other banks due to an overexposure to falling bond prices. While Moshirian believes the banking system is not about to collapse, he points out that people initially believed the subprime mortgage crisis had been contained. This triggered the global financial crisis. To mitigate the risk, the Federal Reserve announced a new program that allows banks to borrow funds backed by government securities to meet deposit customer demand. This is intended to keep banks from being forced to sell government bonds, which have been losing value due to rising interest rates. However, there are more pressing concerns for the technology sector. SVB catered to Silicon Valley, investing in startups and other technology firms that traditional banks might avoid. As economic conditions worsen, the sector has been laying off workers in recent months. One of its most ardent supporters has gone bankrupt just as they require financial assistance.
Americans can rest assured that our banking system is safe. Your deposits are safe. Let me also assure you, we will not stop at this. We'll do whatever is needed.
The American banking system is really safe and well capitalized. It's resilient.
We are in a fundamentally different position that with the reforms of the global financial crisis of 2007, 2008, we've put in place stress tests and other tools that our regulators have to provide more resilience to our banking system.
That's what swift action that my administration over the past few years is all about. Protecting depositors, protecting the banking system, protecting the economic gains we've made together for the American people. Thank you, God bless you, and may God protect our troops. See you in California.